All right, good afternoon, everybody. Event Trader here, about to be joined by Brett Manning, chart trader. Brett, how you doing?
I am doing very well, Gavin. How about yourself?
I can't complain, can't complain. Getting in towards the end of a Friday here, the end of another week, and moving in on the holidays, which definitely has a little bit of a weirder feel this year around, doesn't it?
Very.
So, just trying to get everything settled there. Obviously, an interesting day, and we could start off by talking about that a little bit. Just give a little real time assessment where we've got quadruple witching, of course, today that we need to factor in. And the other thing too, I don't know if you had read my earlier piece around Tesla, but Tesla gets added into the S&P 500 on Monday, which is going to have a pretty outsized impact on passive fund managers and their allocations. So all this could be going on for in the last 10 to 20 minutes of trade. So should be an interesting end to the day. But with respects to quadruple witching, you got any thoughts on that, or any overall arching themes that you like to adhere to during these trading days?
So I mean, the narrative that I'm seeing impacting things, I think that there's structural issues, just like you've just discussed, two of them. But I also think that there appears to be some kind of last minute attempts to shift the nature of the debate around stimulus, and I think the market had gotten to the point where it was seeing the next 800 billion or whatever to be basically a formality, and suddenly there's a little bit of risk that that's not the case. And if you're in a situation where you don't carry much hedging, particularly on quadruple witching, then I think that's going to have an outsized impact on the tape. So I think there's a lot of repositioning underneath the surface right now with respect to some of the headlines that we're seeing.
What about with regards to how this could impact? Because I know a theme that you like to discuss, and we'll talk about it here today as well, given some of the interest rate yields and stock valuations and everything. But you like to focus on the rebalancing, and we're looking at a rebalancing that quarter end that's going to be about three times the size of the usual one, just because of the 80 billion that's going to be wrapped up with this Tesla rebalancing alone. So, is there any way that you'd be looking for in terms of advantages that you think you could see in a Tesla rebalancing that could impact other names or even bonds or other asset classes?
So I mean, I think that for instance, fixed weight fund managers have gotten really used to a roller coaster this year. So I think probably we're a little bit more prepared each step of the way, each time we go through one of these extraordinary kind of shifts into quarter end or month end when it has to do with fixed weight portfolios. I'm not really sure how to figure into things in terms of Tesla. I could see it being possible that the aftermath is more important than the run up. After we go through the process of figuring in Tesla, let's say Tesla moves into a correction of some kind, and suddenly it's consuming what 6 or 7% of the S&P. Then that's it becomes a new factor when you've got a stock that could be seen as being as stretched as it is in terms of valuations. Then maybe you start to see some more rebalancing of a different kind, more inclusion of hedges for index exposure.
Yeah, all right.
But I don't know if that makes sense.
Yeah, no, that makes sense. Right now, some of the numbers that I throw out, Tesla's projected to come in about at a 1.5% weighting, which puts it in the top 10. The median weighting is about 0.08, and Apple being the top one, of course, at 6.5% of weighting.
Yeah, no, I'm sorry. I meant seventh in the ranking.
Yeah,
Seventh in the ranking. Yeah,
yeah.
right.
So seventh in the ranking, but still a significant amount. And one of the things I'd be curious about is you trade SPY options, right? On the occasion, I know you usually are in the futures, but do you ever dabble in the options for the SPY?
Yeah, I have. I don't really do a whole lot of it though.
So the average implied volatility for Tesla is about 4%, where it's about 1% for the
Yeah,
S&P. Um,
sure.
do you see this impacting potentially the volatility in SPY options down the road? And would that be
Well,
something
so
that would
that's
entice you a little bit more, maybe?
possibly, but I more look at sort of how it shifts the game theory landscape. So everybody sees that type of data, and then everything works back from there. It's kind of like in a lawsuit, everything works back from your presumptions about what the jury's going to do, right? So when you look at a new factor that skews volatility to that level and how people can prepare for it, then you've got a lot of downstream effects in terms of large portfolio holders. And the main one that I could see is post Tesla being fully included, there may be, for index participants alone, a greater emphasis on carrying hedging.
Right. Okay. Would you be concerned at all about liquidity? Now, one of the arguments that I was seeing is number one, so we know that asset managers need to buy about 120 million shares of Tesla. An average trading day is about 45 million shares. So that's a pretty big appetite there. And there's a concern that there might not even be enough sellers out there. Now, the other aspect of this playing in too is that people are going to have to sell other stocks in order to buy this. Is there going to be a lack of liquidity out there for some of these names is a concern for a lot of people. And one of the things that I would note is that a lot of people think that the quadruple witching is going to help provide that liquidity. So, Brett, on this, if you saw something like Tesla just fly higher because there's a lack of supply out there, and the demand is so strong that it drives that share price skyrocketing higher. And if you saw some dips in other markets, is there any way that you'd play that in particular yourself?
So yeah, I mean, I can understand. Basically, let's take the abstract point. The abstract point is if something can happen in real time that suggests the possibility of let's say, a mispricing of assets based on technical factors. That would open up an obvious inefficiency-based trading setup back the other direction for every skew that happens once there's enough time for liquidity to reimpose itself. And so the question is, in real time, can the markets, through all the different layers, manage to avoid the initial mispricing effects? I suppose that I have probably and possibly more faith than I should that the layering will work, and that if you see a large change in prices, that it doesn't necessarily represent an inefficiency-based opportunity in the other direction once greater liquidity is found. I think that there could be a trap for assuming that the move represents an obvious give me in the other direction, but I could be very wrong about that. I think that it's such a complex network of channels that people have to handle this, and such a well understood dynamic in advance of it, that it's difficult for me to see in real time there being such an obvious opportunity to play the other side of a skew. Does that make sense?
Yeah, no, that makes sense.
Okay.
Okay.
And I could be wrong about that. I mean, that's sort of my abstract bias coming into a situation like this, generally speaking.
Right. Okay. Let's break into then our usual talk around the sentiment and flow data that we are seeing right now. And I did find it interesting. We've got a couple of great data points ahead of this discussion, Brett. We got the Bank of America Global Fund Managers Survey and their flow charts to take a look at. Some good data from a sentiment trader as well, and the latest AAII. So I did want to kind of jump in on the AAII because a lot of the data and sentiment that we were seeing from the other surveys were extremely bullish and continue to be so. But I guess that's kind of why I wanted to discuss the AAII here first, just because we did see a fall off in the bullish sentiment, which I found pretty interesting here, as we kind of hit a little bit of a lull at that 3,700 level. But from December 10th to December 17th, we saw the bullish sentiment drop about 500 basis points from 48% to 43%. Neutral picked up the majority of that, running from 25% to 30% of correspondence, while the bearish sentiment remained pretty neutral, falling a slight amount from 26.86% to 26.29%. but a little bit of a move from some of the bullish camps to the neutral camps, which I think was reflected in the market moves that we've seen. How do you interpret this AAII data from December 17th?
So first of all, I look at the AAII as a data point basically on a 5-week moving average and over large periods of time. And I don't usually take 1 week to the next week shifts to be very meaningful. It's not a very big sample size. It's like 500 people
Yeah.
that are surveyed. And you tend to get a lot of noise from week to week. But when you see let's say the 5-week moving average for the bull ratio or the bullish percentage or the bearish percentage cluster in an area for a period of several weeks. So if you look at a 5-week moving average clustering for 4 weeks, you're talking about a lot of time where you're seeing a consistent emphasis, even if it's fluctuating 5% here, 5% there, one way or the other. You start to see like when we got really bullish on the market over the summer. That was part of it, right? If you recall, we saw the 5-week moving average of the AAII data really cluster to the point where people were extreme bearish for a period of like 13 weeks. And while you don't know week to week what the implied kind of flow through of those sorts of opinions are in terms of how people are behaving, when you see that period of time go by with that consistence of a scoring, you know that it's going to be speaking to the larger positioning basis that the market's going to be holding, which means if the information, the world starts to shift away from that, you have a lot of readjustment that people are going to have to do to play catch up. And so in other words, a vulnerability builds up as you start to see that data point hammer home again and again and again. So we are right now, I think, seeing fluctuations that show this consensus bullish sentiment extreme building into place. But I don't really take that 1-week data point change as being all that meaningful. I guess if it started to trend and over several weeks we started to see it, it would figure into things a little bit.
All right. So we will move on, but we're going to start down first with, I think, a good starting point building off this AAII is the sentiment trader, which is down towards the end of the document that we got in front of ourselves there, Brett. And no surprises here. There was a lot of data points that were jumping into the overly optimistic camp here. We've got the name exposure index, which is very similar to the AAII. The robo and lobo put call ratios were all at extreme optimism there, as was naturally the options speculation index and the AIM investors. The mutual fund cash level was another one that hit that, and we'll get into that in a second. The NYSE high-low ratio, that remained in play. I was a little surprised at that because I would have thought that the 52-week lows would have had a pickup there around some of the value trade and that we've been seeing in the reopening trade over the last couple of weeks. So I was surprised to see that on there. But with regards to the data points that we're seeing, and any of the ones that I had mentioned, if you want to add on there, Brett, was there anything that was sticking out to you, or does this kind of all play into what we're seeing in the sentiment data?
So, yeah, I mean, as far as I can tell, we've got a lot of extremes. We've talked a lot about that. Everything is starting to gel into this extreme bullish zone. But the other thing that we're seeing at the same time is, I would say, and we'll talk about this in a little bit with the flows data, what I think we're seeing a little bit is that the base of market participants is expanding. And so some of these data points become possibly a little bit misleading because you're dealing with a lot of new cash coming in from people who hadn't previously been a part of the tapestry. So it's kind of like the usual suspects that we've been dealing with in this market, and that's obviously a broadly undefined idea, but it still exists in the abstract. There is still such a thing as the population of market participants, even if it's difficult to identify. And a lot of what you do when you're looking for sentiment data extremes is a read into sort of the future outcome distribution of market moves, is you're making assumptions about how much of the ammunition has been committed to positions that are expected to work. And there's kind of a life cycle to a trend that really has to do with exhausting the supply of ammunition to some extent. It's an abstract way to think about it. But if you add in a large number of new market participants, and I think the golden example of this is maybe 95, 96, 97, 25 years ago, where we saw a massive flood of new market participants, people becoming enthusiastically engaged with the stock market and finding every last penny they could get to start betting on stocks. That was a big expansion in the population of market participants. So anytime you have a dynamic like that going on, it's really, you've got to kind of take sentiment data like this with a little bit of a grain of salt. So we're getting glued into these zones where we're seeing a wide number of different indicators, trustworthy indicators with good relative history, get glued into this extreme bullish territory. But we're seeing, like we'll talk about, we saw the all-time record of cash flows into equity funds last week.
Right.
$46 billion of new money came into equity funds. And I think a great deal of that is not just cash coming off the sidelines of current market participants. I think it's new people starting to say, I'm ready to get involved in the stock market for the first time. And that kind of thing shifts the equation a little bit. And I think that, it makes sense to start seeing that. Take the news flow from today away, but basically, you've got all these vaccines appear to be working. You're sort of past the uncertainty bubble around the presidential election for any, practical perspective. And we've got and we'll talk about this as well, when we see in the fund manager survey, just this sort of all-time record expectation of a steepening yield curve, commodity strength, the cyclical recovery. There's basically nobody's giving any chance toward next year featuring a cyclical recession of any kind. It's because we're coming out of what we just come out of, and because of the vaccine strength, unless there's some terrible miscalculation there, the odds of a cyclical downturn next year seem to be basically zero or thereabouts. So that makes it really tough for the traditional class on Wall Street to start positioning for anything like a genuine bear market, and you start getting lots of new money coming into the market. So it may be that what we're dealing with right now is a skew. We've got a lot of traditional sentiment data metrics that are glued into extreme territory, but ultimately they're going to be overwhelmed by a sort of new stampede of cash coming into equity manager funds.
Right, and that could probably play out what we're seeing too with one of the things that was sticking out to me is 2020 is set to have the fewest losing streaks in history, Brett. It's basically what they define that as. There's only been 32 days that were part of back-to-back losing sessions, the fewest since 1928.
Now, when I saw that, do you think that takes into account March, which basically every single day was part of a back-to-back losing streak?
Yeah, so I was looking at that data, but if you look at it, basically we get 2 days down and then a little bit of a pop. Then 2 days down,
a little bit
of a pop. Yeah, it's because I saw
Okay,
that.
so we're talking 10 or 15 of those 32 then.
So
in March.
it kind of falls in to just go looking around. I do see a 3-day losing streak from March 19th, from March. Hold on, March 18th,
I can
19th,
believe that.
and 20th.
It felt like every day was crash, but yeah.
It did, but it was actually a lot more of you get that puke and then a little bit of a pop, then another big puke and a little bit of a pop. Right. And really that kind of falls into a lot of the derivatives trading that we've talked about, and the idea that, the movie theater example that you always use for the buying versus selling has kind of been put on steroids, I find.
Yeah, I would agree with that.
Where you see that selling come aggressively, and I think a lot of it just has to do with the fact that we're so tied up in derivatives products, and it's a bigger and bigger percentage of the market, that it just lends itself to having that big aggressive drop that all of a sudden people start buying in and getting that V-shaped recovery a little bit quicker. I mean, how many times over the last 15 or over the last 5 to 10 years would you say we've had the discussion, well, we'll work our way back, but it might take some time, and then the next thing you know, a FOMO trade's breaking out 2 days later. It's just been things move a lot. Bear markets happen in a lot shorter time frame, I feel, these days.
Yeah, and I think that you could, I mean, this is a conversation for another time, but I think that you could start to make a sort of broad structural argument about the rate of information dissemination
Rate
in the
of
world.
information certainly plays a factor, right? I mean, it's a lot different than in 1929 when you just see your neighbor
Sure.
running out to a bank, right?
Right. You mail
Um,
a letter, a month later it gets to the broker. Yeah.
yeah, exactly. So yeah, no, that definitely factors in there. Any thoughts about this being a reference to 1928 or pure coincidence?
What?
That we would see the
Oh, I
least
see.
amount of losing streaks in history since
I mean, you
1928.
can data mine everything. I don't know.
Exactly. I agree. I agree. I was just figuring I'd throw that out at you. Then the last piece on the sentiment trader, just wanted to get your thoughts on. Latest tally of Bloomberg shows prominent strategists on the streets expecting the S&P to gain a further 10% in 2021. It's a big jump from the recent surveys. And the other aspect that they were looking at was Wall Street analysts that have been extremely optimistic and have been upgrading a net of 75 or more companies on average over the past few years. So, um, but the thing is, both of these have seen pretty poor returns following
Hmm.
such upbeat expectations. The
Sure.
S&P, when it's seen that, the next 1 to 3 months, according to Sentiment Trader, have been pretty spotty. And the same can be said about returns for the S&P when analysts have gotten that aggressive on what you may call it on stock price target upgrades. So you got any
Sure.
thoughts on that?
Yeah, I mean, absolutely. You're looking at an anecdotal data point that has probably one could conjecture it has an enormous correlation with sentiment data generally. And usually speaking, when everybody's overly bullish, the market's going to have poor returns. That doesn't mean there's going to be a giant bear market, but the idea of a massive swing to the upside is a little bit tough. Analysts are going to have an easy time making larger positive projections for the future when they feel very comfortable with the same data point that's making everybody consensus bullish. So it's really, I think, just, but that doesn't mean that it's going to be wrong. Surely there's some periods where you're seeing a gigantic expansion. You have a big process of cyclical recovery right in front of the market. Even if people are overly positioned for it, you could see a dynamic where you end up bringing in a lot more of a wider base of market participants to help fuel it. But I mean, I think that it's an obvious data point to see that when analysts are really comfortable making big positive projections, that's going to correlate to a period where, generally speaking, you've got too much bullishness baked into the market.
Yeah. All right. So let's continue along here then, Brett. What we're going to do is we're going to move on to the Global Fund Managers Survey, which always has a lot of great data points. I think it goes without saying that it was showing an extremely bullish environment, and we're going to go down and take a look at some of the different aspects of this and how we see that factoring into markets. With the December FMS survey, investor sentiment was bullish as vaccine hopes helped induce a strong buy the reopening trade. Obviously, playing out as we see, bulls are adding exposure in the consumer, commodities, and emerging markets, with 60% saying that emerging markets will be the best performer in 2021. Obviously, a weak dollar factors into that, so I'd be curious as to your thoughts on that emerging market area and the dollar in particular.
Yeah, so I mean, we talked about this probably the last three times that we've talked. Our theme was so there's the weak dollar. We were both bearish on the dollar, going back probably like 3 or 4 months. Um, and the idea is the weak dollar is going to help drive commodity markets. It's going to help drive flows into emerging market funds. It's probably going to help drive the yield curve to steepen, but it's not really the factor that's responsible for all of it. It's a tailwind, and the factor that's responsible for it in a lot of cases is you have a lack of demand from these markets and a lack of preparation for demand from these markets because of the pandemic we saw last year. I mean, if you go back to April, we had crude at negative $40 a barrel, and emerging markets basically expected to never recover. So you've got no money flowing into, let's say, expanding copper mines, right, or expanding oil supply capacity, or placing money in the hands of, let's say, Brazilian entrepreneurs. Like there was a gigantic carve out and a gap. And as soon as you start getting around the corner and we're expecting some gigantic recovery, then, obviously you see the other side of that coin. And I think that's what we're seeing.
Right. Okay. So, obviously, a key story for us to follow going forward with the commodities, Brett. I know you've been following oil closely here. There's been a few data points where I would have thought we would see oil get hit a little bit harder than it has, and it's been able to maintain a pretty steady bid for the most part. I would say rising up towards that 50 level, which I believe you had as a target a couple of weeks ago here.
I would say 53, yeah, but yeah,
53 to be exact. Okay, so 50 for the nice round number. But with regards to the commodities and bullish sentiment building around that, how do you view that impacting oil here? I know gold, I believe you recently added back. I've been pretty steady in my gold position here. I continue to like it and haven't wanted to get too antsy and sell off too quickly. But what's the commodity outlook with that you're looking at here?
Yeah, I got really probably lucky with gold that I added basically right at the bottom of that pullback. And it wasn't that was my thought. I gave it a lot of leeway, but it just happened to turn the day after I added to it. So that was nice. But so with oil is the most simple example of a dynamic that's going to govern so many things that you see across so many markets. So the crash that we saw last year after the onset of the pandemic in March, in April, in May, in oil, it was something you're never going to see again. You're never going to see a situation where oil is selling for deeply negative prices, and the biggest problem people have is too much oil and they don't know where they can keep it. And that's basically that. I mean, you're not going to see that kind of game theory landscape reemerge, at least in our lifetime. I can't imagine. But the idea that comes off of that, the PTSD that comes out of that is why would we ever invest in new wells at that point? We don't know that there's going to be the second lockdown, maybe a third lockdown, maybe a vaccine will turn out to be impossible. Maybe this is a 2-3 year process. So new capital is not going to get assigned to the role of developing new production capacity for oil. There's so many different things across the entire spectrum of markets around the entire world that had some version of that logic attached to it. So as soon as we're on the other side of this idea and we're getting the vaccine pushed out there, there's normally, and the other point is to make, so normally over the course of any given year, over the course of any given quarter, there's some amount of development of extra production capacity for oil. The supply of oil is constantly growing, just like the demand, until eventually, I guess, sometime in the future when we reach this elusive moment called peak demand. But into that point, basically, you're always developing new supply. So when there's a period where there's no investment going into it, it has to be made up double time around the next corner, or there's going to be a shortage. There's a lot of different dynamics that all carry that same basic logic to it in some sort of abstract analogous dimension, where there's been a lack of preparation for a world that works in a more normal way. And regardless of whether or not suddenly people are willing to engage in that world now in a more normal way, it has to go double time because it has to make up for this period where there was just a cliff dive in all of that assignment of resources over the last year. So we're going to see a lot of dynamics over the next year that really reflect a counterbalancing of that and that probably prop up things like heavy cyclical assets in ways that people aren't really prepared for.
All right. Let's move along then, Brett, to some of the tail risks that we're looking at, or that fund managers are seeing. And I found this to be particularly interesting because number 2 and number 3 were new additions from the November Fund Manager Survey. We'll start off. Number 1 remains COVID-19, but that is down from 41% to 30%. I would assume that's some of the vaccine news, because you remember last time, Brett, we were talking about this. It was, I think, the fund manager survey would have been released like 2 days before the Pfizer news came out, I believe. So obviously, the vaccine headlines that we've been seeing over the last month have helped reduce that. But number 2, fears of inflation jumping on to 24%. We'll take a look at some of the other inflation numbers too. But it's interesting because from my perspective, I feel like this is the first time in at least a decade that the Fed's had the ability to inspire the idea that they can drive inflation. And certainly, I think you could argue we've seen it in certain asset classes, such as stocks, where inflation has helped elevate valuations here. But it was interesting to see. Everybody seems to think that the Fed could get inflation going, except for the Fed now. If you're going off
Sure.
of, from the Powell comments from Wednesday, where he was showing some skepticism. I don't want to say skepticism, but that the Fed was going to be able to achieve its inflation targets anytime soon. So, do you find this an interesting dichotomy between what the market sees as the Fed's ability to drive inflation and the Fed's ability to drive inflation at this point?
Well, you could also see it as the evidence of the market's recognition that it's not just about the Fed anymore. So my broad theory, and the reason that why I continue to hold exposure to gold, it is really about. I believe that over the course of financial history, there's these moments where there's a crisis, and some form of genie is let out of a bottle, and it never goes back in. And I think that this period that we're seeing right now is the genie of. I would say you could simplify it to fiscal policy being a really common and driving force in things, or you could say, this is the bridge to modern monetary theory and direct monetization of the debt. But I think there's a period here that's showing us that it's going to make people believe that it's okay to consistently use big fiscal packages, not just every time we're in the middle of a terrible crisis. But even, the way the Fed uses interest rates, just, hey, we see some problems on the horizon, let's do $800 billion bill. So I think it's possible that what you're seeing is not just about the Fed. It's about a new emerging paradigm for countercyclical policy response that is a coordination between the Fed and Treasury in a much more overt manner than we've seen in the past. And I think that, to me, I feel like that's a near certainty. A lot of people disagree with that idea. I feel like it's a near certainty. Why would we do something different than that? All of history shows that that's what happens. You get into a situation where you've got a new tool that makes everything okay in a terrible moment, and suddenly you get to a process of being used to using that new tool every time you could have something. Because in the moment, when we go forward in the future history of the world, there's going to be constantly something that seems like the worst thing ever. That's a risk. It's not necessarily damaging things that much, but it's easy to think that it's the most important and worst thing ever, and you immediately go with that go-to tool. And if that go-to tool now includes not just quantitative easing, which we got used to over the last 10 or 12 years, but now really using the Treasury in concert with the Fed, I think that's an engine for driving a inflation of a monetary phenomenon sort that is something that we haven't seen to that extent.
Did you find it interesting that there was a GOP member that was trying to tack on language that would disrupt that?
Toomey, right?
Yeah, Toomey. Yeah, I was surprised. I talked to Carmine. I just figured it was Rand Paul,
Right.
who I'm assuming is on par with that. But yeah, no, I just found that interesting that inflation had piled in there, and I'll be curious to see how that Fed Treasury dynamic goes. Obviously, Yellen getting in there, a former Fed chair, one would think that they would be able to work in concert together.
Yes.
But the third fear, and I'm kind of surprised that this wasn't on in November, this is new, is the fiscal policy drag. Obviously we were fighting for fiscal policy a month ago, but I guess maybe the sides are of the mindset that maybe this time there's not going to be anything done until after the Georgia elections or at all. Certainly, Republicans have found their religion on fiscal tightness again. So
That's what I'm getting to. Yeah, right. Yeah. So do you see this as something that's going to be a cooperative structure in Washington, D.C.?
To be determined. I think obviously it's going to be a little bit more difficult, but I don't think it changed all that much from the November timeframe when this survey would have been run, I guess is my thinking.
Well, I guess there were so many more risks.
Yeah.
We didn't have a vaccine, and the presidential election was still.
Yeah, the vaccine was far more dominant at that point for sure.
Yeah.
So yeah, fiscal policy drag, obviously a political risk there, and we've seen political risks in the past just not really have the negative impact that some fear on the markets, right, Brett?
Sure.
So, which is interesting because next one up's credit event. They're all derivatives of the credit event of a credit event. I would say that we're looking at, but there was a pickup in worries about the U.S.-China trade war. Do you think that's an element that perhaps people thought Biden was going to remove the tariffs, and now we're seeing some more action actually being taken around, particularly Chinese chip plays? Or where do you see that increased tension around the U.S.-China trade war, at least in terms of a tail risk?
Well, so I mean, I don't have a crystal ball, but I mean, my understanding is the EU and Japan have already reached out to the Biden administration to form a coalition response to China.
Right.
It's what I think should have been done from the start. What I think is a really obvious solution. You can't, if you have your entire end market sitting across the table from you, obviously it's going to carry a tremendous amount more weight than just the United States. Everybody's got a vested interest in this relationship. And in shifting it in the exact same way, there's complete overlap in terms of what the interests are. So it seems to me like that's a really effective change in the narrative. Yeah. I don't know. I already Xi Jinping in the next 5-year summit and everything, he's already anticipated this, and he's already talking about really we need to start internally developing our own technologies at this point.
Yeah. So,
I mean, that's a change in their response, because I would think that he would see the exact same thing.
Yeah,
a loss in leverage.
It makes sense. He's definitely losing that leverage with the unilateral approach, no longer looking like the baseline for the U.S. here. So, all right, moving on from risks then, Brett. Let's take a quick peek. COVID vaccine. Respondents were asked when this will start positively impacting the economy. Obviously allowing for more reopenings. 42% of investors applied Q2 of 21, 28% said Q1 of 21. So right there, we've got 70% of the respondents expecting that in the first half of the year. 19% said Q3. Now, I would say that maybe this is being a little bit overly aggressive on when they think that this is going to start happening, but I suppose this is also built off a little bit of some of the earlier surveys that we were seeing, Brett, when people were being asked when they expect a vaccine to be coming into play. And recall, we were seeing mid-2021, and then it got edged down to like March of 2021, and finally, obviously, it came to fruition in November of 2021. I think in the November survey, they were down to December of 2021, which again would have been released 2 days before the Pfizer headlines. But do you think people are being a little bit overly optimistic here, or do you think that this is that this seems to be right on key? You've got a pretty good pulse on the whole virus and the expansion of the vaccine. So what's your thoughts on that?
Okay, so if I were answering this question, I would have said Q1 21. And the reason is, the question is, when will it start positively impacting the economy? That's not the same thing as virus-inspired herd immunity being existing. So there's supply chain thoughts to think about. It's the same thing that we see with oil. Why is the January contract for oil trading up to $50 a barrel? It's not because there's a massive increase in demand right now, but it's because people understand that there are supply constrictions coming, and they're starting to store up oil for when we have vaccine-inspired herd immunity. So there is. Let's say we've got herd immunity because of the vaccine by June or July of next year in a lot of the developed world. Well, you're going to have to already be ready to handle the increase in demand at that point, which means there's a lot of investments that need to happen over the next 6 months to the degree that you feel complete faith that that's going to be the case by June or July. So it's really about people saying, I know this will be the future, and therefore I have to start preparing for it so that I can take advantage of it or capitalize on it. And I think that goes through a lot of supply chains. So I think that the process of it starting to impact GDP is probably next quarter, even though we will be in a situation where we aren't anywhere near herd immunity inspired by the vaccine by that point. Does that make sense?
Yeah, no, that makes sense.
Okay, so I think that's what the question really boils down to.
Right. So hold on, give me a quick second here. Okay, so Next up, let's talk a little bit about the cash position, Brett, which we had already mentioned in Sentiment Trader, was seeing a pretty overly optimistic number, and as well as the fund managers survey, where the bears have noted the cash level has fallen to 4%. This triggers in the fund managers survey a sell signal with asset allocations underweight cash for the first time since May of 2013. That would have been right towards the end of the European debt crisis, right? I believe right around when Bernanke made his speech on unwinding
Hmm.
fiscal
Yeah,
stimulus too. So
the taper tantrum.
yeah, the taper tantrum. So a pretty interesting time frame for there. And what's your thoughts here on cash on the sides? And one of the questions I guess I have is, do you think that cash on the sides is maybe being underreported in the idea that we know household balance sheets are in a much better position here, and they will be, and that we have an increased amount of money being pumped into the system on the money supply. So, how do you view these cash readings, and would you be viewing it as a sell signal, or do you think that there's some variables in play that perhaps the sell signal that's being triggered here might not be appropriate?
Well, so I think that it might not. And it goes back to what we talked about before. If we're seeing a massive expansion in participants, then it shifts because this is really just a measure of, for current portfolio managers, given their current assets under management, what percentage of those assets do they have in a cash side account, right? Or are they holding 4%, 5%, 6% in cash, and the rest of it's fully invested? When you start to get down to 4% or just under 4%, then you start to get to the point where, generally speaking, if you get some new change in the environment that's unexpected and bad, they'll feel like they need to raise cash, and so they sell more aggressively rather than hold through it. It's basically like a hedge in a way. It seems to run along with something like the equity hedging index. When you don't have very many puts, you don't have very many hedges, you don't have very many future shorts, you don't have very much cash. Those are all periods where people think they don't need to have a kind of protective sheen because things are so unlikely to go wrong. That's when something goes wrong, the market is the most vulnerable. However, if at the same time there's $46 billion a week coming in that's not a part of that equation, then it shifts things a bit. So the number we talked about before with the flows, the 46.5 billion dollars flowing into these funds, that's not in the same equation for how much they've apportioned in cash. So they're taking in a lot of new investors, or at least so it would seem, which kind of shifts, I think, the meaning of that data point to some extent. But it does identify their psychology, and to the extent that you think there's a contrarian role for that psychology, if everybody is really, really complacently bullish at the same time and things turn out not to be quite as rosy as people are assuming, then the market's extra vulnerable.
Yeah, I thought one of the interesting things, Brett, too, was the net percentage of FMS investors underweight cash. Again, first time since May 2013. But they've also stated that this is indicative of an early stage recovery, similar to recoveries seen in the great financial crisis around October 2009 and the dot-com
Yeah.
bubble of 2002. So I did find that interesting that that they see this as an early stage recovery. Do you see this as an
Well,
early leg of I mean, obviously we've had the S&P rally about 40% off the lows here. So would you say that that language holds still here?
I mean, I guess I get I get their point. In that, so I think the reason why that dynamic happens is for the very same thing that I just described. At the point where you come out of, let's say, the dot-com bust, the main dynamic that allows people to carry a smaller amount of cash with a very low likelihood of a cyclical recession in front of them is probably the assumption that they're going to see a lot of new money, a new asset, a growth in assets under management. So they don't need to be as tight because they're taking in checks week in, week out. So there's part of probably why that tends to be correlated that way. And as far as the current environment, I don't know if it's the type of new cyclical boom that you see lasting for the next decade, but certainly the idea that, just like we talked about with crude oil, just like we're probably going to talk about with emerging markets, you have a situation where there's probably a lot of cyclical growth coming in the next 4 to 6 quarters, and it's probably difficult for the economy not to turn out that way, which certainly carries the same dynamic as coming out of a major recession or bear market.
Okay. Next piece I want to talk about, I found this interesting. Asked what corporations should do with cash. Investors split between improved balance sheet at 44% and increase capex at 42% as recession ends. I was definitely interested to see the pop in this here. For a while, we had been, for the last couple of months, we'd been seeing a pretty heavy lean towards improving the balance sheet, certainly
Absolutely.
over buybacks and stuff. So we've talked, Brett, a lot about the inventory levels that are around, and that companies have done a pretty good job, at least anecdotally from what I've seen, in keeping these inventories low, particularly on the retail side. So the idea here is we could hit escape velocity when this signal flips, where the increased capex goes over the balance sheets. Would you agree with that?
So when this flips, as in
When this flips, when respondents are looking for an increase in capex well above the balance sheet, that is basically the idea of when we could hit escape velocity, and I suppose really drive asset prices higher.
Well, supposing they do that, yeah.
Because right now we've had it'll be interesting because we've obviously had the recovery in the stock market, but Main Street hasn't seen that recovery. What happens when we see the Main Street recovery? Does that just blast off and kind of works into the inflation discussion that we've had, the gold discussion?
It works into every discussion we've just had, I would say, right?
Yeah,
it's the same. It's the same dynamic that we just talked about with the cash levels and the early stage idea too. So if you've got this coming, and this is the thing, I think this is the broad assumption that's very, very much in place right now. If it turns out to be wrong, there's going to be hell to pay. But everybody's lined up around the idea that regardless of what the stock market's going to do, there is this very clear cyclical recovery period that we're coming into in terms of economic data and supply chains.
Right. So we've talked about the cash, some of the numbers that we've got out there, the amount of cash that's come off the sidelines, allocation to equity and commodity, net overweight, highest since February 2011. Highest allocation to emerging markets since November 2010. Doubly interesting because, as we just discussed, 60% think that emerging markets will be a top theme in 2021. Investors are still overweight in the U.S. and EU, even with these jumps. And the jump in allocation to consumer discretionary and industrials was the highest since April 2014. The jump in allocation to banks, first overweight since January of 2020. And we still have, of course, the CCAR results expected later from the banks, or from the Fed. And
that's a yield curve dynamic, wouldn't you think?
It is for the banks. Yes. You're saying in reaction to the yield curve. Yes, I completely agree with that. That's the correlation
of the same thing we were just talking about.
The correlation,
but in the yield curve.
Yeah, the correlation between the 210 spread and the XLF is something around 0.75 right now, Brett.
Yeah, and if you think we've got this broad cyclical recovery coming, and the Fed's not going to raise rates, then that's what you get.
Yeah. And again, tech remains the largest overweight, which is amazing. I mean, it just kind of shows the amount of money that we have flowing in, and a dynamic that I'm going to talk about in a second. But and then the idea that the reopening rotation has been best expressed by 31% of investors for long small caps versus large caps. So you're really seeing a drive in the IWM and the small caps there. So just really some amazing numbers. It really speaks to the optimism that are out there. Adding to that, Brett, more investors say the global economy is in an early phase. 70%, this is the highest since 2010, of a bull market run, as opposed to a recession, which was seen in 2009, 2012, as a key recovery milestone. So we're getting this allocation, we're getting this flow in, we're getting this bullish sentiment, but it really still seems like there's more upside to this too, doesn't there?
Well, and certainly people are positioned for it, and I guess so. I go back to what I said at the beginning. I think we are at this. If you look at sentiment and cash and hedging and all of these things that we like to look at as on a kind of stochastic basis. They're already pushed at the point where all of these opinions and these assumptions are there. And it's really, to say that this is going to blow off on a parabolic run from here is really about, are you getting lots of people who haven't been previously very involved in the stock market to start to pour in the way that we did in the late 1990s. And that's possible. I mean, I'm telling you, it can happen for sure, especially in an environment where we've been through this hell and we suddenly have maybe, let's say, a little bit greater degree of political stability, and we've got this new fiscal plus monetary stimulus model. We've got the vaccines that are just starting to run out. We're going to need a ton of new investments in things like oil capacity expansion, all sorts of stuff. There's plenty of money out there to fuel it. And for the segment of the economy that's been sort of the work from home, not unemployed segment, you've got way more cash than you typically have on the household balance sheets. All that lines up to say, any rational person can look at the situation and thinks they're going to be better tomorrow than they were yesterday, and that's going to be a daily habitual mantra for possibly the next year. And under those circumstances, you could imagine a lot more money coming into the market. But without that, the market is pretty much sitting there already discounting all of that. So we'd have to get a popular herding input of sidelined money from people who haven't been overly active in the stock market to kind of make good on that idea.
Yeah. Okay, moving on to some of the flows we've seen here, Brett. No surprise, we're getting some incredible flows in. There's been 917 billion into cash in 2020, 359 billion to bonds, 127 billion to stocks, 54 billion to gold. That's just in 2020 flows. Now the 917 billion into cash, again, when we're looking at a measurement of cash on the sidelines, Brett, being at lows, there just seems to be more cash that's flowing in here, and that's reflected in that flow data. But the number that I wanted to get is over the last couple of weeks, we've seen a record 140 inflow in the stocks. This is over a 6-week period. But last week we saw the largest weekly inflow in stocks since February of 2018, as equity allocation is closing in on an all-time high of 62.5%. Now, you always talk about the rebalance. How do you see that factoring into the rebalancing here when you hear a number like that?
You mean specifically, explain the question.
So we are seeing a record amount of the highest allocation to equities all time. Now, Now at some point, if you're in a 60-20-20 fund or something, and you're at a 62.5% equity allocation, from my understanding, you have to readjust that and buy bonds.
Yeah, I got you.
To get to 60-20-20 or whatever it might be.
Yeah, so like according to charter kind of rebalance.
Exactly.
Yeah. I mean, well, there you go. Right. Like, obviously, it doesn't necessarily have to impact the trend if it's swallowed up by other dynamics, but it's a factor, and it's a factor that lines up with, the same reason why I was shorting post-Fed the other day. There's an argument to be made that without a tsunami of new money coming into this market, that there's going to be a lot of people caught wrong-footed because they've gotten overly complacent without any hedges in place and too little cash in terms of sitting in their active spread of their portfolio. So everything needs to rebalance. The typical way is a correction. The other way is a tsunami of new money flowing into equity funds.
Right. Okay. Last two things. We're just about running up on an hour. I just thought of two things to throw out there for some fun, Brett. And the first one I'm going to throw out to you is a statement that I saw that Wall Street has been nationalized, and it's really built around the idea that central banks, through modern monetary theory and such, have really just taken control. I mean, the Bank of Japan, I think, owns over 50% of the Japanese stock market now. Certainly, treasury markets don't even really trade anymore for the most part. It just seems like it's the Fed selling to itself. Thus, the allocation concerns for some people, I think, where they're going to be forced into. buying some poorly performing rates and really have a tough time matching returns from some of the equity only focused individuals. But what do you think of when I say that Wall Street's been nationalized? Do you agree with this, or what do you think we would see that goes deeper in that would have you a little concerned that that would indeed be the case?
I think that it's a little bit hyperbolic language,
Sure.
but I get the gist of it. You use hyperbolic language to really make your point. And, what seems to me that occurs to me whenever I kind of contemplate this sort of dynamic, there doesn't seem to be any penalty for it.
Yeah.
What's the penalty? So why wouldn't things just keep evolving in this direction? There doesn't seem to be any penalty for this type of process, and maybe it's just an evolutionary step. We're just becoming, we're just adopting gradually over the course of a decade a different paradigm in the relationship between the traded markets and policymakers.
Yeah, no, I'd agree, and I don't think it's been nationalized, but I think it's going to be a growing theme that you're going to see over the next few years, especially if central banks do not get out of the markets.
I guess the penalty could be, in theory, a liquidity issue at some point.
Yeah,
But
yeah,
I mean, I don't see. We haven't seen the penalty yet. I mean, maybe you need to get to the point where you see a tangible version of why this is problematic before policymakers.
yeah. Unless we get some of the zombie companies taken out, it just doesn't seem like we will.
No.
We won't get that creative destruction that I think is so pertinent to capitalism. It's something that we haven't seen really in 10 years since they let Lehman go. But next question's going to be, Brett. A lot of people talk about the valuation for the stock market. Now, I've been arguing the last few weeks here that you can't, given the last few months, given the amount of monetary stimulus that's been put into play and potentially fiscal stimulus, you can't really look at your normal forward PE model and just go off of that. Now, I've been talking a little bit. I posted the CAPE index by Robert Schiller, in where he discusses some of the evaluations. And of course, we got the Fed model too, coined by Ed Yardeni a few years back. This model is based on an equation that compares the earnings yield of the S&P with the 10-year yield of the Treasury there. And I had sent you the chart of this, Brett, but it's really a pretty big spread here. The S&P forward yields earning about 4.59% compared to about 0.93%. Which that's basically a 3.5% spread for owning stock over Treasury. What are some of the things that you'd be looking for on this, and how do you see this as an argument for the valuation?
So I think that it's going to be interesting to see if it pins it back to closes that gap as we start to see people gradually shift, I think, again to seeing inflation as a risk, because the obvious place where this thing broke is when deflation became the primary risk.
Yeah. All right. So with that, Brett, in terms of the overall material, is there anything that you were interested in discussing that we did not touch upon?
No, I mean, I think that we've kind of covered the bases here, but the big picture is really that we're seeing an unusual level of vulnerability just in terms of hedging and cash levels. So from a sentiment and flow show standpoint, we'd have to point that out, that there is basically a broad assumption that next year is going to be really, really great. And, that we're coming off of the situation where supply chains have been hampered, and it's almost impossible to envision a cyclical recession. And, it shows up in the analyst data we talked about earlier, where it's really easy to start to make some really big projections. And that's probably emblematic of all the sentiment data points that we're seeing. And the question is, can they make this sell? Is Wall Street able to sell that to Main Street in a way that brings in a great deal of new assets under management, which is really, what the business is all about. But at this point, if we see, if that doesn't materialize, you can't just discard the idea that the data still matters and that big negative inputs into the equation. People aren't positioned for them right now. It would take raising cash and it would take buying hedges, and that is selling across the board. So a turn, something unexpected that it makes it difficult to make that sell. The market is definitely vulnerable to a shift like that. It's just right now, it's tough to see around the corner in such a way that it suggests that this is a major cyclical risk. There's very little in the way that would suggest a cyclical risk for a serious downturn. So the complacency is probably going to build, and probably to some extent that sell is going to be successful, I would imagine.
Yeah, especially since we've seen the COVID headlines get probably as bad as they can, and they have hardly made a dent in sentiment or market activity. And, just with the idea that that could flip with the vaccine next year, it's tough to see anything but us drifting higher for the final 2 weeks. Now, as we had talked about in the past, anytime we had seen sentiment get this bullish, the next 1 to 3 months had been a little sloppy, so perhaps we're seeing some sloppier trade action in January and February. That could definitely be on the table. But I think more than anything, it's difficult to find the ability to short going into these final 2 weeks of the year. So I'd certainly be looking to lean more on the longer side would be my take, given the sentiment and the flows that we're seeing out there. So, all right. Well, Brett, any parting shots here before we say adieu for the end of the year here?
No, except for happy holidays to everybody, and you too, Jeff.
Happy holidays to you and the family, of course, Brett. I hope the triplets are getting ready for Santa to come moseying down the chimney.
3.5-year-olds at Christmas. The first time they're really going to understand what's happening.
Do you do the elf on the shelf?
They're fired up.
Do you do the
What's that?
Do you do like the elf on the shelf form or anything like that?
I don't know the Elf on the Shelf reference. I've got a 14-foot tall Christmas tree in the living room, and they love it. So
there you go.
There you go. We've got a tremendous amount of excitement around the holidays right now, and it's difficult to not have that with three-year-olds who are just starting to understand the joys of the
concept.
So.
Good for you guys. Good for
it's
you
fun
guys.
Stuff.
And happy holidays, of course, to everybody that's out there. Scott might be jumping on here in a second, but if not, we are going to be closed down for the next week on audio. Jim's taking a little bit of a break, so but we will be up the final week, jumping in from time to time. We will still be trading next week, so please continue to follow the site, of course. But for audio, we will be closed for next week, so just wanted to give you that. But everybody out there, happy holidays, and always a pleasure talking with you. Hopefully, we did you some justice this year and can make you even more money in 2021.
Hear, hear.
All right, Brett, you take care, buddy.
Take care, Gav.